Hey, hello, Jack Tubbs from the J Team at Realty One in Surprise, Arizona, coming to you on this beautiful sunny day here on Thursday in the Valley in Phoenix. A little bit chillier today, but still, as you can see behind me, a lot of beautiful sunshine and just a beautiful day here in the Valley. I want to talk to you about some changes that are going on with the FHA, mainly about what kind of loans Fannie Mae and Freddie Mac will still back, what they will still insure. And that it's focusing on investment properties. They decided they're going to drop the total amount of portfolios that they will, as they're buying mortgage-backed securities, or they're buying mortgages, that they're going to limit that to be only 7% will be investment properties. And this is going to change things for a few investors, because you know what? They depend heavily on the 3.5% down, the lower rates that are offered by Fannie Mae and Freddie Mac through the FHA guidelines, all these other things. But they're going to reduce what they're going to purchase by 7%. Now, this is going to cause some of the investors a little bit of a hardship. I think probably most savvy investors will still find a way to get the job done, but it's going to be a little bit more tougher. As I came to yesterday, that we see the FHA, Fannie Mae, and Freddie Mac tightening their credit, which means more scrutiny. They're going to invest more wisely, safely, what they feel is more wisely and more safer for them. The GSE has really been happy about the kind of money that it's been bringing into the Treasury, and they don't want to mess that up. So they're going to tighten up their lending practices, and they're also going to drop down the money that they will spend on investment properties down to 7%. Now, there is going to be one exception, and these are going to be second homes that have high loan to value ratios. In other words, if they're borrowing $100,000 against the property, but there's already equity in the property, say another $100,000 in equity property, they'll still do that, and they still will, but that will have to be manually underwritten. It won't have to go through the desktop underwriting software, but will have to be done manually, and it'll have to be done under special feature code 840 when they do a investment property under these special circumstances. But otherwise, you know what? This also, as I read this and I kind of study it and I see what I studied yesterday to share with you, it sounds like the FHA is expecting some problems on the horizon as far as the housing market goes. And I just want to continue to assure you that here in the Valley, under the conditions we're in right now, with hardly any inventory and a lot more buyers than inventory that's available, the builders are still scrambling to catch up from what the business that they've been falling behind on, because the scarcity and the lack of materials, how they've had to raise prices because the materials that they are getting in are coming in at a much higher price than what they were originally buying them at. We still see all these different things that point to we still have a red hot market here in the Valley, and probably down in Tucson and some of the other areas throughout the state. And we're also going to see that situation probably duplicated in Florida and other areas that have red hot markets right now. So as far as what the business and the market that we see here, as I said yesterday, we'll still see price increases month over month. We'll still see probably records broken as long as inventory can kind of keep up with demand. We'll probably see sales volume continue to grow year from year. We're just going to see, we still have all the elements for a really strong and vibrant and healthy real estate market here in the state of Arizona. Investors, you may want to start lining up even more private funding, or be able to find some lenders that can work with you with, say, on 3% down or 5% down conventional loans to help finance your investments. You may not be getting the same rate, but you know what? If you can find the right loan to value ratio on a home, it won't be that big a difference, as long as you know that your profit margin is going to be built in that will cover any extra interest rate costs that you might incur. So with that said, this is just the news that I wanted to share with you today. And the FHA is going to reduce the amount of mortgages that they are going to insure as far as investment properties down to 7% of their total portfolio. There is one exception. It's going to be a second home with a very high loan to value ratio. And as I said, that will have to be manually underwritten. It won't go through the FHA desktop underwriting software, and we have to use special feature code 840 to get those properties done. Now, if I can help you, if I can refer you to a lender that can even give you the new rules and the new exceptions in greater detail, please give me a call. You can call me direct at 248-330-7972. That's 248-330-7972. Or you can email me, jack@thejteam.house, and that's Jack, Jack, at THE, the letter J, the word team.house. Or you can call the office and talk to any of my team members. They can also refer you and help answer your questions. And you can call them at 623-252-4061. That's 623-252-4061. Hey, this is Jack Tubbs from the J Team at Realty One in Surprise, Arizona, wishing you a fantastic Thursday, and I'll see you tomorrow with more about what's going on in the Phoenix real estate market. Have an awesome day.